Good afternoon, everyone. Welcome to our weekly meetup. So I'm Charles, and for this week, Edmund asked me to share with you my thoughts about the market and a little bit of my process. Right. So I titled my presentation "What I Know and What I Don't," and because I'd like to start here to give you guys a perspective or a view of my perspective. No? So all right. So here I've summarized the things that I know and the things that I don't. And if you look closely, you might realize that there's slightly more things on the right than on the left, right? I don't know when the peak of the cases will be. I don't know when the vaccine will come or if ever it will come, and I don't know whether the market has bottomed or whether or what type of recovery we'll eventually see. I don't know if it's L, V, what U, and all those letters. I don't know, right? And so if you might be thinking, if you look at this slide and you see all of the questions, all of these uncertainty, you might ask me, okay, so given all of these uncertainties, should we end this and just sell everything and just watch Korean dramas, right? And I think the answer is no, actually, right? Because if you think about it, risk goes both ways. What do I mean by this, right? If you buy everything today, if you go all in, then you risk losing money, right? Obviously, right? But if let's say there's too much uncertainty, you sell everything, right? You go cash and never open your account again, right? The risk is now missing an opportunity, right? If you're waiting, for example, for a new low or for a retest, right, of the 4,000 level, and let's say it doesn't come, right? Then it rallies all the way back to 8,000, then that's a risk also, right? And I didn't invent this actually. I read this in one of in Howard Marks' report, Howard Marks of Oaktree Capital, right? And so what's interesting about this risk, these two risks, is that you can only manage one at the expense of the other, right? If you go all in, then it means the risk is all on the left, on the first one, losing money. If you go all out, missing an opportunity. If you go, let's say 50% in, then it's a little bit of both, right? And so my point here is that you can't really eliminate risk by not doing anything, right? By just staying cash, not doing anything. You can't really eliminate the risk. No, and the key is to strike a balance. No, it's a personal balance. No, it might be different for you or me, depending on your strategy, depending on your condition. It's different for everybody. But the key is there has to be a balance. No? And the balance would be the ultimate, the ultimate strategy that you do, the ultimate exposure would be driven by probabilities, right? So the reason why I shared the first two slides is because I would like to encourage all of you guys to think in probabilities rather than certainties, right? What do I mean by this? I guess 2 points. First one, don't chase for the 100% trade, right? Don't wait for a trade to be 100% sure before, or even close to that, 80%, 90%. Don't wait for it to happen because it's never going to happen, right? The only time we're 100% sure of the trade is after the trade is done, right? And if you think about it, let's say you want to wait for the time wherein we already know the answers to all of the questions on slide 2. The peak of the cases is already clear, the vaccine is already out there, everything is well, then by definition, markets will already be priced in, right? I mean, the good news will already be priced in, and there's no more opportunity, right? So that's the first part. Don't. It's okay to not be 100% sure, or not even 80 or 90% sure. That's okay. And number 2, my second point is that if you're listening or reading opinions, predictions, analysis even from experts, please understand that nothing is certain, right? Even the best stock market traders or investors, I would say they're probably right like 60% of the time. And that's already very good. They can already outperform over the long term, right? So those two things, whenever you, and for me, for example, if you ask me, gun to my head, am I bullish or bearish? I probably say I'm bullish. But it doesn't mean I'm 100% sure that markets are going to rally over the next week and over the next 6 months. I'm not 100% sure. It's all about probabilities, right? This framework I've used ever since. I believe it's true at all times, but more important today, right? Why? Because I think you would agree with me. The number of voices has definitely gone up. The number of opinion has gone up with the increased uncertainty in the market, right? So there's just so much you read right now. You can if you listen to all of them, and some of them are, or most of them are even conflicting each other, right? So please understand these are probabilities rather than certainties, right? And so that's my overall framework of the market, right? Um, for the remaining of for my remaining part, I'm gonna share to you at least a little bit of my process, right? And so whenever I do any trade, okay, whenever I do any trade, I try to consider all of these factors, right? I try to look at sentiment, overall sentiment in the market. I look at technicals. I look at government policies, BSP or the Fed. I'm looking at foreign selling, insider buying, right? All of those stuff. But just for this next maybe 5 minutes, I'll just be focusing on liquidity and solvency, right? This is the focus of this presentation, and yeah, because we probably don't want to hear me speak for hours, right? So, but just to tie it up to my earlier slides, please understand or remember that you don't have to be an expert in all of these variables to make a trade, right? The goal is just to increase your probability, right? Once you increase, if you can think of it as, increasing your probability from 50 to 55 to 60%, then again, over the long term, you should be able to make money and outperform, right? So again, liquidity and solvency. So why is this important? Okay, because I believe eventually, okay, this too shall pass, right? I know, everybody's saying all the governments are late, wrong decisions left and right. I know, I know, I can hear all of these things, but I really believe that eventually this will pass, right? I don't know how many will ultimately die or how long this will be, but eventually it's gonna normalize again. And so one of the most important thing is for us to just keep our heads above water for now, right? So stay at home, just stay healthy, social distancing. But for companies also, it has a certain meaning, right? For companies, this means high cash position to weather the storm, minimal debt, obviously, because refinancing will be an issue, right? Might be an issue, and obviously resilient cash flows. We want to make sure our cash flows is reliable going forward, right? So for any companies that I try to buy or I consider, I look at these three variables at least, just to start. They're not all of the variables. Again, just to remind you, I also look at the others like the chart and so on. But these three factors are essential for me at this time, right? So let's try to. I'll just show you some examples of how I do it, right? It's very simple. Don't worry, right? So, for example, for the first one, I have here Pure Gold. This is one of the earliest stocks that I've liked. Maybe 3 weeks ago, right? Unfortunately, it has gone up already, but yeah, I'll still share the process. Maybe there's opportunities again, right? So for Pure Gold, if you look here, you will see the cash. This is what I'm looking for: the cash and cash equivalents of 8.5 billion pesos, right? So 8.5 billion in cash, right? And you might say, is this high? Is this low? You have to compare it to your debt, right? For this one, the debt is here, long-term loan, that's 400 million. So definitely much higher than the debt, right? 8.5 billion versus 400 million, right? Notice I don't include the short-term loans payable. This for me is working capital. That's okay. That's easily, refinanceable, right? So just this one, long-term debt. So notice 8.5 is much bigger than 0.4. So that's good for me, right? Worst case scenario, you can use your cash to pay off the debt, no problems whatsoever, right? The next thing that I will look at is operating cash flow. Here we have 4.3 billion in OCF. Operating cash flow is the amount of cash you generate from your day-to-day operations, right? And so where do I compare this to? I compare this to current liabilities, right? Current liabilities meaning your obligations for the next 12 months. So notice here for Pure Gold, 84% is a very high number, meaning you can pay almost all of your obligations just by your day-to-day operations. No? And I guess more importantly for Pure Gold, we are expecting minimal disruptions for 2020. Everybody knows that Pure Gold's products are your staples, right? So we don't expect any material slowdown. In fact, some like COL is even expecting a benefit for Pure Gold, at least for the short term, because of increased hoarding, increased buying, right? So notice Pure Gold is very good for the three variables. For the next one, I like to contrast it to another company, Petron, right? Petron has 52 billion in cash, as you can see here, 52 billion in cash, right? You might say this is 6 times bigger than Pure Gold, right? Which is good. But actually, if you compare it to its debt, right? If you look here, it has 141 billion in debt. So 129 in long-term debt and 12 billion in the current portion of that long-term debt, 141 billion. So notice again, the debt is much higher than the cash, which is not what we want, right? So that's a bad thing, right? And then next part, operating cash flow is 21 billion. While this is bigger again than Pure Gold's operating cash flow, it's as a percentage of current liabilities, it's much smaller at 18%, right? Recall Pure Gold's is 87%, so this is much smaller, right? So and again, lastly, for Petron, as everybody probably understands, right? We have an ECQ, right? And so the demand for gas has gone down significantly, right? So we anticipate the demand to slow down and we anticipate this to hurt revenues for the foreseeable future, right? And lastly, Petron is also facing inventory losses. What does this mean? At any point in time, Petron is holding on to crude oil inventories for refining, for processing, right? And with the sudden and sharp drop in crude oil, that inventory would have to be marked to market, and that would result into losses for Petron, right? So that's another headwind that the company is facing. So in all three levels, I think it's in a worse position compared to Pure Gold. So another example, this is my last example for now, is Robinsons Retail. It has gone up a little bit also, but not as much as Pure Gold, right? Here, again, we look at the cash. Cash is 20 billion. But what's notable for RRHI is that in addition to this 20 billion, it has 15 billion or 14.8 billion in additional financial assets. These are mostly in the form of bonds. So the company's holding bond investments, right? Fixed income investments, right? So for me, I treat them the same. So effectively, they have 35 billion in cash, 35 billion in dry powder, so to speak, ammunition, right? So that if you even think about it, right, they can use that cash to, buy distressed companies if the opportunity comes around. So that's very good for Robinsons Retail. Just to put things in perspective, right, in better perspective, market cap of Robinsons Retail is 100 billion pesos, right? So 35% is in cash and cash equivalents, which is very, very high for any company. So that's one positive thing that I like, right? And more than that, if you look at its liabilities, it doesn't have any debt, right? So again, even better, right? So no refinancing risk, no default risk, and a lot of cash. right? And in terms of operating cash flow, 12 billion for 2019. That's 37% of current liabilities. Not as high as Pure Gold's 84%, but still higher than Petron's, right? And maybe one comment that I've heard about Robinson's Retail is that it has exposure to department stores and specialty segments, your fast fashion brands, right? But note that 70% of revenues comes from supermarket, convenience stores, and drugstores, which will be more resilient than the other businesses, right? So 70% of the revenues are stable. By the way, you can also find this. You can everything that I've shown you, the table, the numbers. You can find everything in the financial statements, either the quarterly report or annual report, whichever is the most recent. So you can definitely get these information easily, right? But if you're too lazy or intimidated to do this on your own, always remember that you can still use your broker reports. As some of you might know, I'm from COL, so this is my obligatory shout out to COL. Right? So please, there's value there. So try to read them. Even me personally, I read the reports of the other analysts, right? So I get value out of it also, right? So that's it. Before I end, I just want to remind you guys, even if you do all of these things right, let's say your assumptions are correct, your process is correct, even if you consider the other factors as well, always remember my earlier point a while ago, probabilities, not certainties. Nothing is 100% certain, right? Don't wait for that to happen because it won't happen, right? And the key, therefore, again, remains to be risk management, right? For long-term investors, boss has always mentioned, just save, just invest 20% of your income to manage your risk. For traders, always honor your stops, always do the right position sizing, right? So these things remain key, right? Don't think that there's 100% trade that we can go all into, right? And last but not the least, right? Because it's probabilistic, you always have to be open-minded because probabilities can change overnight, right? As more information comes, let's say tomorrow a vaccine is finally approved or what have you, right? Then probabilities can easily change. So we always try to be open-minded. We always try to recalibrate our expectations and act accordingly, right? And so that's it for me. Thank you so much for your time. Stay safe. And I'm now passing you on to Leonard. Thank you.
Okay. Thank you, Charles. It's a wonderful explanation to some of the things I'll be talking about. My task will be to help you guys try to categorize the companies that you are looking at and to set expectations for them. Okay. And I'll give some of our favorite stock picks also in the US. Okay. So I'm gonna base it, which I always recently use this, is an article by the Modoran on how he looks at the companies in the current situation. And it's a long article, so you can read the link if you want to, but I'll try to discuss them one by one in the coming slides. So don't worry about the lots of text here. Okay, so I'll go to the next slide. So one of the stocks that you would see this round, as Charles had shown, are the ones with high debt and lots of cash flow issues. So we call these stocks that are distressed, right? So they're very high risk. You would see them falling 80 to 90% already from the peak. And in fact, if the crisis continues, revenues are probably going to zero. So the risk is high, and expectations for these stocks would be that expect very high volatility. And as Charles has said, in the long run, it's very hard to have a good grasp on how this will end for these companies. Some will probably go bankrupt. Some will probably survive and have a huge upside. So in the long term, you can treat them as options, but it's very gambling oriented if you want a longer term picture at this point. So some examples will be travel-related stocks. So there are some in the Philippines. Casinos also, because casinos have very high operating expenses and high debt. So when your revenues go to zero, that's a lot of problems. So you may see these stocks falling 90% and say, wow, they're the most cheap stocks I should buy. But where? Because they're very high. And if life doesn't go back to normal soon, they will have problems. Okay. So the second one, we call this lower risk stocks, are what we call bargain basement. Bargain basement meaning they're bargain and they've fallen about 50% from the peak. They're lower risk because if you use Charles' method a while ago, generally they will survive this crisis. Their debt is low, they have cash, their market cap is huge, and the problem is they were waiting for the turnaround to happen. So they may stay cheap for a while. Normally, we do quick short trades for these stocks. They're very attractive long-term picks. So COL will have a good list of these stocks that they want, but they can stay cheap for the meantime while the crisis remains in place. In the US, we have consumer stocks that are cash rich also. You have Lululemon, Chipotle, CMG, and even the giant semicon equipment manufacturers, they're very cash rich. They will survive this crisis, but for the meantime, they will get hit. So that's why the stocks have also fallen. All in all, for the left side of the chart, which I will show the right side in a bit, you can prioritize if you believe the recovery will be quick and the impact on the economy will be small because they've gotten so low that you want to pick them up. For our trading purposes, we're looking more on the right side. We think this could take time. But again, as Charles said, we really don't know. Things could change in a moment. And when things suddenly look promising, we might just go back to the left side immediately. So we're very nimble and keeping our list open also. Okay, so I'll talk about the right side now, where we stand today. On the right side, the lower risk stocks, we call them stocks at a reasonable price. Reasonable because they have fallen the least during this crisis. So if you're a trader and you run relative strength screeners, they would be the first to come out. Why did not they fall the least? Why did they fall the least? Because they are the companies that will not only survive, but are poised to take advantage of it. They're what we call safe havens for now. They're also very huge in market cap and low net debt, as Charles had explained. So, example a while ago, like the Pure Gold, the RHI, right? They will survive and their demand may even be stronger during these times. What we expect for these are for swing trades. So we want to buy low and we want to sell high. They are going to be market favorites as long as the crisis prolongs. But given that they're also reasonably priced since they haven't fallen a lot, we expect a lot of channels from these stocks. Examples will in the US are healthcare related because they will continue to be in demand. Cloud and data centers will continue to be in demand because a lot of our communication will now shift online. Online gaming, because what do you do when you can't watch movies outside or you can't do other entertainment spending? You might spend it on online gaming and e-commerce as well, because that's a direct beneficiary, right? Okay, so in the local, I think there are some of those that Charles already talked about a while ago. Lastly, I want to share about one of my favorite categories, but obviously also high risk. We call this the change agents. They cannot be screened by price, but generally they are the new mega trends that may arise from this crisis. If you think that our way of lifestyle will be permanently changed, you should look towards these kinds of stocks. I prefer them to radar or still underappreciated by the market. But even if market has recognized them, I'm still okay in looking at them because their upside could be big. Also, since most of them are still unproven, execution risk remains very high. So for me, these are candidates for your multi-baggers. where your ability to stock pick will be put to the test. And I'm willing to position for a bigger move if the technicals present themselves, right? So I'll show some examples, my favorites in a bit, but sectors that will benefit are health monitoring, streaming services, because where would you go now but to watch streaming, and delivery services such as the food delivery sectors. So they stand to benefit the most from this crisis. Okay, so on the right side, you prioritize these stocks if you think the recovery will be long and the impact economy could be quite permanent for a while. For our team, we're positioning on the right side for now, because we also think that even if the cases can be controlled, there will be still a lot of uncertainty that the market will still have to figure out. But as we said, we don't really know, so we're working on probabilities here. Okay, so this is the whole picture. So bargain basement, there's a lot of them in the Philippines. So I think Charles and his research team will provide the list. But I guess on top of mind are your Ayalas. They've fallen so big, they're probably going to survive. And the problem is it's just a question of when will the recovery and the turnaround happen. Okay. Change agents in the Philippines, probably Globe. Joe Chad talked about it last week. So people continue to be using their data, and even GCash, although still a small portion of their revenues, could stand to benefit from this. Right? So those are some examples. Okay, so I'll go to, since we prioritize the US, I'll go to some examples in the US that are our favorites today. One is what we call Livongo. It's a 3 billion, so it's a small company. And what they do is they do chronic disease management. What does that mean? They offer services to help you manage your chronic diseases better. And according to them, they provide nudges that allow you to save money in the long run. For example, people with high hypertension don't want to check their blood pressure regularly, but are advised to do so. So they will provide nudges regularly. And so far, about 50% of their nudges, they say it's very effective. So they have the broadest digital health offering that includes diabetes, hypertension, weight management, and mental health. Currently, they're the largest, as 30% of Fortune 500 companies have partnered with them. They also partnered with pharmacy benefit companies, so those that provide insurance. So for example, Express Scripts is one of the larger ones. Livongo is a preferred status. Currently, they have 222,700 members. It has grown 96%. And so far in the US, there are about 147 million people with a chronic disease. So the addressable market is very huge, and they do subscription revenue model, so very visible. So this is one of our favorite change agents. So there are other news, but one more is that recently they are leading healthcare provider of the US, who has 12 million members, offers Livongo's mental health service for free. And given these trying times, the anxiety levels are high, and we believe that the mental health services will be very beneficial and will help save people from their anxiety. And then last 3 days ago, they issued preliminary earnings and revised their guidance. So this is a rare company that is revising guidance higher during the crisis. And this supports our thesis that awareness of being able to manage your chronic diseases is rising. So what are expectations? So for example, when it breaks $30, we try already to pick up some of the stocks. But as long as momentum setups continue, we continue to take a position or even add to it, because we believe these are change agents that can really benefit from this crisis. Last, want to talk about Roku. It's a very love-hate relationship between the public in the US. It's 11 billion. It's a streaming platform. And currently, they're the largest streaming device. Second is Amazon Fire. Third is Chromecast. They have 39% market share in the US and about 40 million active accounts. So what is our thesis with this? We believe that as streaming continues to increase, Roku can benefit the most because it is scalable with the number of viewing hours. It is ad-based. And subscription-based fixed services will have more limited upside. And also, as there are more subscription services coming out, subscription fatigue should raise tolerance for streaming ads, especially during these times when people are also trying to cut their budgets. What are the risks? As the risks are always big, remember, as Charles said, manager risks. Risk is that the advertising segment will get hit this year because why would company do more ads when sales are going down? And since Roku is doing programmatic ads, they're the easiest to cut because you can just cut them immediately. However, we continue to keep this in our watch list because we believe that advertising will continue to shift towards streaming, especially as other channels of advertising are unavailable. So ads that are outside your houses would be less useful during these times, and they will have to find a way to access the people. And we think that this platform is one of the good ones. Okay, so I hope it helps what we're trying to share. And Michelle will continue with some more examples and execution of our favorite stocks.
So thanks, Leonard, for that introduction to the framework that we're using today. So, so I'll just be sharing a bit more on the stocks that we have been looking at and how we plan to participate. So for us, we're focusing more on the SARPs, which is the resilient companies, both in narrative and stock performance. Though valuations look very expensive, we feel that these are the guys that will still outperform the market moving forward. And for us, we're going to be using swing trades, which is buying low and selling high. For change agents, which is the favorite of Leonard and as well as mine, we're looking at new mega trends that materialize during the pandemic. So these could be positive or negative changes to how we live our lives, our consumer behavior, individual sectors. And as Leonard said, the execution risk remains high for these companies, but we feel that there is a chance that that these companies can outperform because the upside is really big if they're able to materialize or the adoption kicks in for these companies. There. So here are some megatrend opportunities that we've found. Some were already mentioned, but I'll just go over them for everybody. So we focus more on the US, and these are the guys that we're looking at to help us in our stock picking. So those that are beneficiary to the pandemic, these are esports or online games, since kids and adults are encouraged to stay at home. So this is the perfect chance for them to either start playing online games, do some live streaming, and relax while as a distraction during this pandemic. E-commerce is also expected to benefit as goods normally bought from physical stores are now being bought online. On a side note, pet care or the online pet care stores are actually improving during this crisis because they say that people are buying more stuff for their pets now because they're at home and they have nothing else to do. So stocks like Chewy and Pets are stocks that you can trade in the US that are performing really well during this time. Cybersecurity is also another one that we're looking at since there's now higher importance on the security of your system since everybody's working from home or online. So this was recently highlighted when a company called Zoom, which is what we're using now, has some issues with their security after they experienced a really big spike in usage. Telehealth as well is a mega trend in play as people are now resorting to online consultations to limit the face-to-face interactions with their doctors. online education is another megatrend, as physical teachers or different educational institutions are now introducing online courses, which can disrupt the traditional classroom style teaching. There are also sectors that continue to outperform the market despite the COVID crisis. So these are the more technicals, which is like data and AI, because as companies digitize their business, let's say like new sectors such as telehealth and e-commerce now need higher data capacity and analysis for their businesses. So there is a huge demand for data and AI to help them continue their business. Digital cloud communication solutions as well are being used now, since it enables their workers to work from home. So the stocks here could be your Microsoft, your Salesforce, your Zooms, and your other cloud companies. For 5G, it's also in demand, as internet is now a very important commodity today, and the high traffic in internet use has caused a huge strain in the current internet traffic. So people are still looking to upgrade to 5G. So we think that's still a mega trend we can take advantage of. And another one is medical devices. So for patients that have chronic diseases, like what Leonard mentioned on Livongo, there are people that still need services for these guys, since they're most at risk during this pandemic. So these are the things that we can participate in as traders. Yeah, so I guess I'll start from here again. So this is one of the examples that I'll be talking about for today. So it's SE, which is C. It has Garena, which is its mobile gaming app, and Shopee, which we're all familiar with. So there's a huge surge in traffic for online gaming, and this is, as I said, people are at home, so there's nothing. They can be easily distracted with online gaming, and it's a way to connect to other people who are stuck at home as well. So it's top two games, which is Free Fire and Call of Duty, has top globally. So Free Fire is top 10, one of the top 10 global games in terms of monthly average users. So we think that even though there's a short-term boost in their profitability from their gaming side, we think that this will continue moving forward as they launch newer esports in different countries such as Latin America, India, and other international markets. So stricter social distancing policies and other shutdown of physical stores can also lead to an increase in e-commerce. So Shopee is one of the top two online shopping apps here in Southeast Asia. So it's between Lazada and Shopee, they're rank 1 and 2. So even though there's a lot of competition from other smaller online shopping apps, we think that Shopee will continue to dominate, as it is the one that people are most familiar with and has the biggest breadth of goods on their platform. So this is just our expectation on what the stock could do, not necessarily what it will do. So this is how we're just going to tackle it, on how we're going to participate here. So we consider this stock as a SARP, as it's a resilient company. We feel that there is still growth for this company despite the NCOV. Normally, SARPs are stronger than the market as you would see with the other charts that I will present today. So in this case, it just held at 200-day. While if you look at our index, it fell more than that. I mean, like, yeah. So it's the difference in relative strength is huge. So we think that the market also recognizes this company as a good company. So you'd want to buy low and sell high for this stock. So we expect it to hold here or channel upwards, and we hope to participate in these types of companies. So this is another company that we're looking at. It's similar to SE because it also has some gaming and online content. So Billy provides a wide range of online content. So live streaming, anime, comics, mobile games, and this is all in China. So Tencent and Alibaba have stakes in this company, which is very important because to have the backing of a big parent such as Tencent and Alibaba can help Bilibili survive this whole crisis because there is a parent backing them. So let's say they need some funding or they need support, they can easily get that from their shareholders, such as them. So Billy acquired a 3-year Chinese broadcasting rights for League of Legends World Championship. So this is to focus on their live stream. So the top two revenue drivers for Billy is video content and live streaming. So they want to focus on video content for games and live streaming. So they want to focus more on the live stream, and they feel that that's a big market that they can tap into moving forward. So their monetization rates compared to the other stocks are currently a little bit lower, but we feel that there's room for improvement as this COVID allows them to generate more users and it's hopefully to be able to improve their monetization. So most of its players are Gen Z, and they're said to be very loyal and engaged in the platform. So that's a very good sign that the players that are on the platform can be monetized because they're willing to support the gamers, they're willing to buy additional, let's say the small in-game purchases, and they're willing to watch the live streams, and that would help support the ads of Bilibili. And last Friday, Sony just bought a 5% stake in Billy, which is very good for the company. And it's a sign that maybe this company is a great company because an American company wants to buy it to be able to tap into the Chinese online entertainment industry. So they were able to buy a stake in Billy of 5% to tap into China's younger entertainment market. So these are our expectations on the price. So we think it's a change agent because it's not, there's still some issues on execution because their monetization is still a little bit lower, but we feel that this is still a chance for them to prove themselves as the users are already there and they're hoping to monetize better. So, and there's also like the purchase of Sony is also like a stamp of confidence in its ability to perform, because in this type of market, someone is willing to buy into your company. So it's the same as our previous one. You want to buy low and sell high on this stock, and you want to try to hold on to the challenges if there are. So please note as well that these are just our suggestions on how to participate. There are a lot of ways to participate in this market, and since we're focused on stock selection and choosing the companies that we feel would survive or be resilient during this COVID, this is why we're choosing these examples, or we've actually bought into some of them already. So for our next one, this is AMD. It's a long-time favorite of ours already, and we still continue to like it. It's a semiconductor company which produces chips for PC, gaming, and data centers. So businesses today with the COVID-19 has forced them to digitize even faster than they were planning to. So there's a demand for higher computing power because their data centers need to be able to keep up with their capacity and to be able to analyze more data. So AMD's EPIC, which is one of its biggest drivers of growth today, it's a data center chip, and it's reportedly stealing market share from its huge competitor Intel, which holds the bulk of the market today. So that's a clear sign that its technology is actually getting better or at par with the big boys. So that's why we continue to like it. And as of March, data center chip makers AMD and Intel have said that they're operating at near capacity, which is really rare in this market where everything is slowing down and they're still operating at capacity, which only indicates how much demand there is for their product. AMD has also bagged multiple contracts for gaming consoles, supercomputers, and different PC brands, which is a good sign that people are now looking at AMD as an alternative to their Intel, not just as a cheaper alternative, but as a chip that's on par with the standards of what they're looking for. So expectations on price action. We consider this as a SARP because it's a company that has shown to perform well, and it's a big company with good management, and the technology is also there. So buy low and sell high. We also want to alert some of the people who may want to participate in the stock that there's earnings that is happening by April 28th. So just be careful if you want to participate. So you can either choose to participate after the earnings when there's new information regarding the company's outlook, and then we'll see from there if it's still a company that's worth buying. But I think it's still a company worth buying because I don't think anything would have changed this coming earnings. It's just you're just going to look at whether the outlook or their revenues or their sales are in line with what you're thinking. So that's just a check and balance whether they're still continuing that growth story. So another company that we're looking at is DocuSign, which is the market leader for e-signatures. So aside from just e-signatures, which I think Adobe and other smaller companies, I think even Dropbox has their own e-signature platform already. So what does Docu offer that is slightly different? So it offers other solutions such as for contract management. It's easier to produce a document from, let's say, your HR or from your accounting department. So the transition of digital paperwork is actually very easy when you're using DocuSign because they're thinking of it as a business, not just you signing a PDF. So I think in this type of market where more businesses are forced to digitize, even us on our end, I've received like a PDF for signing, which is really rare. Normally, I would go to the office and sign something. So I think because of this whole COVID, people are now realizing that there's an easy way to manage all of your paperwork. So once you start there, once you subscribe to e-signature apps like DocuSign, it's very hard to reverse that. So I think that it's a very sticky model. So DocuSign operates on a subscription model. So once you're signed on, it's really hard to unsubscribe because the whole process is much easier, and they have high retention rates. which is very good for this company. So they're able to keep their clients happy. And it also has a successful land and expand strategy, which means that once you got them signed on a lower tiered subscription, it's easy for you to sell them upgrades or other solutions since they're already on the platform. And prior to the COVID-19, the addressable market is already huge, and we feel that it's still a market that DocuSign is able to tap. So it's a 25 billion market for just its e-signature, and it's a 50 billion market for the whole contract management solution. And it also has a very strong balance sheet since it's a subscription model. There's not much debt, and so that's why we feel that this is a SARP or a company that we're looking into for a longer term buy. So yeah, there. So it's a SARP, and you can buy low, sell high, and just hold on through the volatility, which most likely there is. So there. So for our last stock, I have here a Hong Kong stock. It's an online healthcare company in China. It's the current market leader for this space. It has self-operated online stores, and it's one of the first that has pharmaceutical e-commerce, because back then you didn't really want to buy your medicine or something related to health online because you're afraid it's either it's fake or you can't really trust the source. So there were strict regulations put in place to avoid that in China. But as early as last year, they've been trying to ease the regulations on this. So they're making it easy for you to pay your medicines online. It's easier now to buy your medicines online. And there's also like online consultations and there. So we think that COVID-19 will accelerate the adoption of online healthcare in China. And most of the growth would be coming from the shopping platform for the health supplements, the drugs, medical devices, and others. So it's backed by Alibaba, and it has lower customer acquisition costs because you're already in the ecosystem. So it's easy to tell them that, let's say, you can pay with Alipay already, or it's integrated in the shopping platform. So that's why it's a good company to invest in. So we think that telemedicine should continue to be a strong megatrend moving forward. So that's something that you guys can prioritize when you're looking through companies. So I saw a question here, which is, what advantages 241 have over 1833 with this Ping An Good Doctor? So we actually like both companies. I just chose to show this company as an example. So they both are leaders in online healthcare, and they have the same growth driver. So you can buy and participate in both companies. So there. So that's all the examples I have for today. I hope that you guys learned something, or for those at least trading in the US or in Hong Kong, have now a better idea on how to participate. And the floor is now open for questions. Thank you very much.
Okay. Thank you, Michelle. Thank you, guys. That was a really great presentation. I'm just going to revert back to Mackie's original question. Will the US dollar and US dollar securities become unstable, very weak, given all the US Fed stimuli?
Okay, so one, this is very macro, so it's not my expertise, but I'll try to share my work. But I said there's a lot of uncertainty here. But what I can say is first to look at price, and that the DXY has been relatively strong despite all the printing, and that currency is a matter of confidence And as long as the market is still willing to believe in the value of the dollar, it's very hard to expect a collapse. That is my opinion. I don't know if other coaches have thoughts on it.
I think it's very similar. So I think what you're looking at today is that the Fed will continue to print, and we've seen it. It's almost at 6 trillion and above already, and it's still not enough, I believe. The positive end is that as long as they hold the largest gold security, they can print as much as they can. So with whether you like it or not, the Fed has unlimited ammunition as long as the gold standard is still here.
Yeah. So regarding the US dollar weakening that we would be assumed because of the money printing, what's happening today is that a lot of the global debt is actually in US dollars. So there's something that Jason touched on whether it was last week or 2 weeks ago in his macro presentation. But primarily all of the US dollar, all of the debt globally is actually in US dollars. So, but the problem is that today, because of the lack of inter-country exchange and transactions between cross-country transactions because of the COVID, what's happening is that there's an increased demand of the US dollar, right? So if you actually look at it in the short term, I don't think that there's going to be any weakness. The significant weakness in the US dollar will probably kick in.
All right. Okay. Thank you. Chairman, is there anything that you want to add?
Well, it was being asked several times this week, no? And I said that you should just focus on gold rather than the US dollar, because all the central banks are printing money anyway, right? So if everybody's printing money, I mean, the US dollar will still dominate, right? So it's neutral. For me, it's really neutral. It's not nothing that we should be concerned about in today's environment. Just the US dollar is against everything else anyway. So they still have the highest in terms of 0.6, 0.7, 0.8% in terms of the 10-year. So everybody's negative interest rates already. So the dollar will continue to be, even with so much printing, they will probably still dominate. Right? But I think the alternative is really that the gold is going to new highs. That means if you are looking for alternative as outside of the US dollar, it should be gold itself, no? Rather than anything else.
Okay. All right. Thank you. We're going to move on to the next question. This is going to be for Charles. Charles will be the one to answer this one. This is coming from Alex. Do you think market has already priced in the potential negative guidance on quarterly earnings report?
I think to a certain extent, yes. Okay, so I think what's being priced in now is roughly about maybe 2 to 3 months of lockdown, the current ECQ, about 2-3 months, and then maybe after that, a gradual reopening of the economy, of the activity. So I think that's what's being priced in. To give you just some perspective, like for COL, for our assumption, for our team, we're assuming 3 months of lockdown, but a faster recovery after that. So it's roughly about 2-3 months, I think. So yes, it's priced in, but if it extends to, let's say, I don't know, to 6 months, or if, for example, there's a second peak later this year or next year, I don't know, then maybe that part hasn't been priced in. Yeah, so a little bit of yes and no for that.
Okay.
I'll also add, because Jason posted a report, I think 2 weeks ago. If you look at today's level in the PSE, and you take a look at the 20-year historical average, which is around 15 times on the market, I think the market's already pricing in a 25 to 30% drop in earnings for 2020. So this was based on Jason's report, I think 2 weeks ago. So just to add, just to some extent, yes, there is some level of market's already pricing this in.
Okay. All right. So Alvin also asks, is there a healthcare play in the Philippines? Charles will also be in charge of this one.
Oh, okay. So currently there are only two, as far as I know. So MPI and AC. Unfortunately, both of them has small, the percentage of the healthcare as a percentage of their value, the market value, is very small. I think for MP, I recall that they sold 60% of their stake already last year. right? So I think right now what's left is about like the percentage of that to their value is about 3%, the percentage to NAV. For AC, I think it's also in the low single digit. So I guess bottom line is no direct play. No, I mean no significant play, as far as I know.
Okay, great. All right. Michelle answered this question earlier, but we are just going to have her respond to the question again, just to make sure that we're clear. This is coming from Christopher. He asked, what advantage does Hong Kong 241 have over HK 1833?
All right. So as discussed, HK241 is Ali Health, which is under Alibaba. So, and HK1833 is Be Good Doctor, which is under Ping An. So that's really the main difference. And what advantage does one have over the other? It's just it's a different play. So Ali Health is more onto the e-commerce part of the online healthcare market, while the PA Good Doctor is similar to Teladoc. They do more online consultations, so they have doctors on their platform that help patients with, let's say, their fevers or the smaller issues. So they don't have to go to the hospital or need to see to have a physical routine checkup. They can just do it online. So we both like them, and I think that they're both gonna benefit greatly from the shift in online healthcare.
Okay, great. All right, we're gonna go into our last question before I think we are way over time for the day, but that's a good thing because that means that we were able to give you as much content as we could for this round. From Mackie again, U.S. earnings are this week or next. Will the short-term rally fail or test recent low or make new lows? Leonard, what do you think?
I think you need to listen to Charles' presentation to start, but in general,
Slide one.
There's a lot of things we don't know. Earnings will be hit. That's obvious, right? So what we're trying to do is for our team is to do some stock picking, which we try to find those stocks that will be resilient and benefit. Personally, if you want my opinion, I'm with Chad's team that this is a rallying mode already. And historically, yes, retests have happened, but then sentiment has been one of the worst this time. So I'm on the camp that it's possible for things to just stay sideways until a recovery happens. That is my opinion. Okay.
All right. Thank you. Thank you. Okay. I guess that's pretty much it. I'm going to call on our boss right now. Edmund, are you there? Are there any?
I have a question.
Yeah.
Regarding your slide, Charles, on RRHI, what's your thoughts on the 20 billion inventory that they have?
20 billion in inventory. I have the okay. I currently don't have the breakdown of that inventory. But if we assume that bulk of it is in supermarket, as with its same as the revenue breakdown, then bulk of the 20 billion would be okay. I mean, in the sense that they can still sell it. 70% of revenues comes from supermarket and convenience store and drugstore. So I think that's okay. We're okay with that. If there's a remaining 30% of 20 billion, let's say that's 6 billion, then to be honest, I think it's a small amount relative to their cash of 35 billion, relative to also given the fact that they don't have any debt, right? So and I guess last point is that inventory for let's say fast fashion or department stores, they don't really expire. So as soon, maybe once the malls reopen and these stores reopen, I don't think that you have to write off all of those or a significant part of those 6 billion remaining.
All right.
Okay. So are there any more questions or none?
We're good. We're good.
Okay. Guys, thank you so much for coming as always. Leonard, Charles, Michelle, I appreciate it. We haven't seen each other for almost a month, and we continue to learn some good stuff. The nice part about this, and especially today, is that all the information that you saw, you can actually find it in most of the financial statements on PSE Edge. And it can be a lot to take, but actually, if you open the annual reports and the quarterly reports, and you slide down to management discussion and analysis and the financial highlights, there's actually just a few pages that you have to go through to search for these items if you want to do it by yourself. Okay? The beauty about everything that was taught today is that because we understand price action, it's becoming easier and easier to spot what are those SARPs and what are those stronger than the market issues. Right? And I think that's one of the main priorities that as a trading house we continue to focus on. And I hope you guys continue to see it from that standpoint as well. At this level, you'll probably, like in the Philippines, you'll start to see why Globe, PLDT, Pure Gold, all of a sudden, after losing the relative strength battle for the last 4 years, now they are now the leaders coming out of today's rally. Okay? It's becoming very easy to spot. So what I always tell people, in these difficult times, you will start to see which are your STARPs and which are your actually change agents during these times. So I hope you guys learned a lot from this episode. And yeah, thanks again.
Okay, thank you, everyone. See you guys.
See you.
Thank you.